We'll now take a look at exercise 9.2 on page 509. It's another lower of cost and net realizable value. Tatum Company has 4 products in its inventory. Information about the December 31, 2016 inventory is as follows. And they give us the product number, the cost, and the total net realizable value. Okay, and then they want us to determine the book value of inventory at December 31, 2016, assuming the lower of cost and net realizable value rule is applied to individual products. So let's start with product 101. Its cost, $120,000. Total net realizable value is $100,000. So the lower of those two numbers is $100,000. Fairly easy concept, I think. We want to report it at the lower of cost or total net realizable value, so as not to be misleading to the readers of the financial statement. If we can't sell it for more than cost, and we show it on the financial statements at cost, then we're actually overvaluing our inventory, which would be misleading to the readers, of course. Okay, the cost on 102 is $90,000. The total net realizable value is $110,000. The lower of the two there is $90,000. Or for 103, total cost is $60,000. Total net realizable value is $50,000. The lower of the two there is your $50,000. And for 104, cost is $30,000. Your total net realizable value on 104 is $50,000. Cost is quite a bit lower there. Okay. So now let's sum cost and inventory value and see if we've had a gain or a loss. Now it would only be a loss. You're not going to have a gain here because you're either marking the inventory down or keeping it on the books at its cost. So I probably misspoke there. You could have an inventory loss though. So let's sum this column. Okay, before our inventory had a valued at cost. Its value was $300,000. Now our new inventory value is going to be only $270,000. Okay, so number one, determine the book value of the inventory at December 31, 2016, assuming the lower of cost and net realizable value rule is applied to individual products. Well, there's your answer to number one, $270,000. Okay, number two says, assuming Tatum reports an inventory write-down as a line item in the income statement, determine the amount of the loss. Well, the amount of the loss is the difference here, $30,000. Well, let's show you how that would work in journal entry form. Remember, we said we had a loss of $30,000. The previous value of the inventory was $300,000. It's now valued at $270,000. So that's a loss of $30,000. And we said this was December 31, 2016. We could put 2016 here. And then this is December 31. We're making our adjusting journal entry here. So we had a loss, which will show as a separate line item on the income statement. We're going to call that loss from write down of inventory. And that would be shown separately as a row on the income statement. Remember, losses increase on the debit side, just like expenses would. And then you probably guessed it already. The account to credit, or the account to decrease in this case on the credit side, is our asset account inventory. Its value decreased by $30,000. I hope that one makes sense. Now remember, the $30,000 is just our previous value of the inventory, $300,000, minus the book value of it at this point, $270. Okay. All right. Good luck. If you work that one with me, I don't think you'll have any problem with exercise 9.2 on the Connect Plus site for homework. Thanks a lot.